Welcome to Prompt Your Life. I'm Christoph Theodor. And today we are breaking down the critical intelligence and high stakes moves shaping this landscape.
Entering 2026, the market is severely divided on PayPal. Investors must determine if they are looking at a decaying consumer application in terminal decline or an undervalued infrastructure asset transitioning into the AI economy. To evaluate the current pivot, we have to look at the structural DNA of the company. It started in 1998 as Confinity, which soon merged with Elon Musk's X.com to establish a massive early mover advantage in digital payments. The initial product vision was highly specific: security software and digital wallet transfers for early handheld devices like the Palm Pilot. That concept found its true product-market fit when eBay acquired PayPal in 2002. eBay provided a captive audience of buyers and sellers who desperately needed a secure way to transact online, generating a decade of rapid viral adoption. But the marketplace that built PayPal eventually became a structural ceiling. Because it was an eBay subsidiary, PayPal was locked out of partnerships with emerging rival e-commerce platforms. The very ownership structure that guaranteed its volume was preventing its expansion. That friction forced the 2015 corporate spinoff. PayPal returned to the public markets as an independent entity, free to integrate with any merchant platform. Decoupling from eBay forced PayPal to evolve from a captive marketplace feature into an independent digital ecosystem. It also removed its protective shield, exposing the company directly to the brutal margin pressures of the open payments market. Those margin pressures have created a severe financial paradox today. For the full year 2025, PayPal generated $33.2 billion in net revenue and $6.4 billion in adjusted free cash flow. Yet the equity markets treat the stock with extreme skepticism. This chart shows the immense scale of the network. The first axis tracks total payment volume, which climbed to a massive $1.79 trillion in 2025. But adding the second axis reveals a hidden vulnerability: take rate erosion. Take rate is the percentage of a transaction PayPal actually keeps. In 2012, that figure was 3.35%. By 2025, it plummeted to 1.65%. The primary catalyst for this compression is unbranded enterprise processing, specifically through Braintree. Braintree processes payments in the background for massive global merchants, generating explosive volume but at significantly lower profit margins. Braintree's surging volume mathematically dilutes the highly profitable revenue generated by the legacy branded PayPal button, which has seen growth decelerate to nearly 1%. In response to this margin compression, executive management executed a defensive capital allocation strategy to protect shareholder equity. They directed $6 billion of that free cash flow entirely toward aggressive share repurchases, systematically reducing the public float. Top-line revenue stability is masking the internal decay of PayPal's profit margins. To defend its market value, the company has abandoned its identity as a high-growth tech darling and embraced a mature, capital-efficient utility model. Recognizing the limitations of the previous strategy, the board brought in Enrique Lores as CEO in early 2025, definitively ending the company's era of broad expansionism. Lores immediately initiated an April 2026 strategic reorganization. This Lores doctrine was designed specifically to simplify operations and maximize the value of individual corporate assets. He partitioned the company into 3 distinct operating units: checkout solutions, payment services and crypto, and consumer financial services and Venmo. The critical change is elevating Venmo to a standalone unit, isolating an asset that commands nearly 100 million highly engaged younger users. Isolating the Venmo platform creates immediate strategic optionality. Management can now aggressively monetize it internally through debit cards and loyalty programs, or package it for a highly lucrative divestiture. This exact restructuring is what fueled capital market rumors in early 2026 that Stripe was actively exploring an acquisition of the Venmo platform. The Lores doctrine functions as a dimensionality reduction strike. By discarding a tangled, unified corporate model, PayPal forces the market to price the true, isolated value of its highest-performing assets. That restructuring is necessary because PayPal is fighting a multi-front war that is actively dismantling its primary historical advantage, the visual, trusted checkout button. The most immediate threat is Apple Pay. By controlling the device, Apple places its payment protocol directly in the consumer's hand, bypassing third-party applications. That hardware control translates to demographic dominance. With 71% of Gen Z consumers preferring Apple Pay, PayPal faces a steep demographic cliff. On the enterprise side, platforms like Stripe and Adyen are ruthlessly competing on technical efficiency, forcing Braintree to lower pricing to retain large corporate clients. Domestically, the infrastructure itself is changing. The rise of real-time payment rails and the Federal Reserve's FedNow service introduce an entirely new settlement architecture. These systems enable pay-by-bank initiatives, allowing merchants to pull funds directly from a consumer's checking account and bypass traditional credit card networks entirely. Instant bank settlement costs fractions of a cent, directly attacking the 1.5 to 3.5% interchange fees that legacy card-funded transactions rely on. PayPal's historical dominance relied on visual brand trust and mastery of the credit card rails. Both pillars are now being bypassed by hardware-native mobile wallets on one end and zero-fee instant bank transfers on the other. The underlying logic of the payment industry is rapidly shifting away from human-computer interaction toward machine-autonomous settlement. The industry calls this agentic commerce. Instead of a human scrolling a website, a personal AI assistant evaluates options and executes the transaction. Gartner projection models forecast that by 2028, 15% of all global retail transactions will be autonomously decided and completed by AI agents. This creates the invisible storefront. If a machine makes the purchase, they never visit the merchant's website or see a visual checkout button. AI agents do not care about legacy brand recognition. They execute purchases based entirely on structured, trustworthy, machine-readable data signals. Currently, the market faces a massive readiness gap. While 95% of merchants report incoming traffic from AI agents, only 20% possess the machine-readable catalog infrastructure required to actually serve them. PayPal moved to close this gap by acquiring Symbio in early 2026, securing the technology to structure merchant data feeds directly into large language models. For the financial settlement of these autonomous purchases, PayPal is positioning its own PYUSD stablecoin as the programmable base layer. A machine-to-machine economy requires absolute finality without human arbitration. Millisecond-level real-time settlement is a non-negotiable requirement for an AI agent finalizing a contract. To survive the AI economy, PayPal must completely abandon its reliance on the visual application layer and embed itself as the invisible programmatic protocol layer beneath the transaction. The equity market is actively struggling to price a company caught between these massive structural vulnerabilities and its aggressive AI infrastructure pivot. This matrix compares PayPal's valuation against its peers. PayPal currently trades at a forward PE ratio of 9.32. The broader industry averages 18.15. Investors are looking at a 50% discount, trying to determine if it's a value trap or a bargain. The bearish thesis points to decelerating checkout growth, persistent margin decay, and demographic losses. Conversely, the bullish thesis is anchored by $6.4 billion in free cash flow, allowing them to systematically extinguish outstanding shares and mathematically raise the stock's floor. This technical chart demonstrates that institutional money may be acknowledging that floor. The 50-day moving average has crossed above the 200-day moving average, signaling a potential bottoming process. The current extreme multiple compression means the market has already priced in a terminal decline. If management can prove the core business is simply stabilizing, the resulting risk-to-reward ratio becomes highly asymmetrical in favor of the investor. Ultimately, PayPal's trajectory in 2026 comes down to execution. Long-term shareholder value depends entirely on the flawless implementation of the Loris Doctrine, stripping away inefficiencies to leverage assets like Venmo and Braintree. Operationally, they have to manage the complex new liabilities of agentic commerce. When an autonomous AI initiates a purchase without human consent, PayPal must establish the legal and financial responsibility for that transaction. The legacy identity of a trusted blue button is over. The future requires a cryptographic engine capable of settling millions of contracts per second. PayPal must successfully pivot from a consumer-facing application into the invisible, stablecoin-driven clearing engine of the AI economy, or face permanent structural obsolescence.
Disclaimer: the content on this channel is for informational and entertainment purposes only. I am presenting my personal investments and strategies here as part of Prompt Your Life. This does not constitute investment advice, a recommendation to buy, or financial analysis. Investments in the capital market are associated with risks. Always act at your own risk and responsibility.